Have you ever actually wondered if it's possible to build a system of absolute trust, like exchanging value without ever having to rely on a bank, a government, or, well, any traditional middleman at all? Just imagine a world where trust isn't handed down by some centralized institution, but is instead guaranteed entirely by cold, hard math.
Welcome to today's Explainer. We're decoding blockchain from cryptography to the Genius Act. We're going to embark on a seriously fascinating journey today. We'll be exploring everything from the raw foundational math behind digital ledgers all the way up to the real-world regulatory impacts that are literally happening right now. All right, let's dive right in.
So here's our roadmap for this explainer. We're going to start with the decentralized digital ledger, then look at cryptography, specifically hashes and keys. After that, we'll break down Merkle trees, check out some real-world blockchain applications, and wrap up with challenges and US regulation.
Kicking things off with Section 1, the decentralized digital ledger.
At its absolute core, a blockchain is a decentralized, immutable digital ledger. And immutable is really the magic word here. Once data is securely recorded and verified across the peer-to-peer network, that's it. It can't be modified. It can't be deleted. This completely transforms the database into a single, unforgeable source of truth. There's no central administrator who can just, go in and cook the books. Instead, any changes to the records require the consensus of the entire network. It's a real game changer.
So let's actually walk step by step through a single transaction to see exactly why this architecture is so incredibly secure. Step 1 is initiation. A user requests a transfer or maybe triggers a contract. Then, Step 2, verification. A massive global network of computers, we call them nodes, algorithmically checks the rules to ensure the user actually has the required funds. Moving to Step 3, block creation. That verified transaction gets grouped together with a bunch of others into a block. Step 4 is consensus, where all those nodes agree on this single version of the truth using a specific consensus mechanism. And finally, Step 5, chain addition. The block is permanently, irrevocably locked onto the distributed ledger. It is, honestly, a masterpiece of distributed, verifiable trust.
Moving right along to Section 2, cryptography, hashes and keys.
If you want to visualize how digital signatures actually work, the classic mailbox metaphor hits the nail on the head. We all know the mental model, right? Think of your public key as the mailbox itself. It's visible code. Anyone walking by can just drop funds or messages right into it. But your private key? That's the physical key to the mailbox. It's a highly secret code required to actually unlock the box and spend those funds. So anyone can know your public address to send you value, but only you hold the private key. That ensures you have absolute, non-repudiable control over your own assets.
But keys are really only half of the cryptographic equation here. The other half? Hashing. A cryptographic hash function essentially takes a long input of data and securely shrinks it down into a fixed-size, tamper-evident output. Now, to work properly, a good hash function needs 5 specific properties. It's got to be efficiently computable. It must be fully determined by the input data, so no random variables allowed. It has to use all the input data, otherwise sneaky changes would go completely unnoticed. It must be uniformly distributed, and crucially, it has to generate vastly different values for similar strings. Meaning, if you change just one tiny comma in a massive book, the resulting hash output doesn't just look slightly different. It looks completely, totally unrecognizable.
To really grasp why those 5 rules matter so much, let's contrast 2 different methods. Take the flawed modulo 10 method, for example. It basically just grabs the last digit of a number. It ignores almost all of the input data, and it has a massive collision rate, meaning entirely different inputs will easily spit out the exact same output. And for a financial ledger, that is a total security disaster. On the flip side, the historically older MD5 algorithm beautifully illustrates how a stronger function actually works. It's highly complex, it creates a fixed 128-bit output regardless of your input size, and it is hypersensitive to even the smallest changes. So the big takeaway here is that collision resistance, making absolutely sure no 2 distinct inputs can ever get the same hash output, is absolutely critical to preventing fraud on the network.
Which brings us to Section 3, Merkle trees explained.
Now think of a Merkle tree like a giant upside-down binary tree. Down at the very bottom row, you have your raw data blocks, say all the individual transactions inside a block. The system hashes every single one of those. Then it pairs them up, concatenates them, and hashes them again. It just keeps moving upward, compressing the data layer by layer until it finally forms one single, easily verifiable Merkle root at the very top. Because of this brilliant structure, if even one tiny piece of data down at a bottom leaf is tampered with, that change cascades all the way up the branches and completely alters that final root hash. It's an incredibly efficient way for lightweight nodes to prove data integrity without having to download the entire gigabyte-heavy blockchain. But you might be wondering, just how foolproof is this tree structure really? Well, recent research from Proxima Labs gives us some pretty vital insights into root collisions. They actually analyzed the mathematical probability of vulnerabilities in Merkle trees, and their findings? They indicate that increasing the tree's path length, meaning making the tree deeper with more layers, actually raises the probability of a root collision. However, and this is the flip side, increasing the length of the hash itself significantly reduces the likelihood of those collisions. Understanding this delicate mathematical balancing act is absolutely critical for developers who are out there trying to fortify the security of blockchain systems today.
All right, let's zoom out a bit for Section 4, Real-World Blockchain Applications.
This tamper evidence structure isn't just theory anymore. It is actively disrupting major global industries as we speak. Take healthcare. Blockchain's immutable ledger is currently being used to encrypt sensitive patient records. This allows for highly secure data sharing between providers, plus automated smart contracts for insurance processing. Or look at logistics. It's serving as a powerful track and trace tool, giving companies real-time visibility from the manufacturing floor literally all the way to your front door, while stripping out unnecessary middlemen. And in banking, it's completely revolutionizing cross-border payments, heavily reducing fraud through immutability, and dramatically speeding up traditional settlement times. It's basically the scalability of trust applied directly to global commerce.
Finally, let's tackle Section 5, Challenges and U.S. Regulation. Now, to be fair, we do have to acknowledge the significant bottlenecks that blockchain still has to overcome. The two absolute biggest hurdles right now are scalability and energy. As these networks grow in popularity, they face severe congestion. Processing every single transaction across a network of thousands of distributed nodes, yeah, that takes time, which leads to painfully slow processing speeds. Furthermore, systems that rely on a proof-of-work consensus mechanism consume massive amounts of computational power and electricity. I mean, we're talking energy usage that sometimes rivals entire small countries. That results in a really heavy environmental footprint. Solving these scalability and energy constraints is paramount if we're ever going to see true mainstream adoption.
Looking back, this innovation actually started way back in 1979 when computer scientist Ralph Merkle first patented hash trees. Fast forward to 2008, and the pseudonymous Satoshi Nakamoto publishes the now legendary Bitcoin white paper. And now let's jump to some major recent legislative milestones in the United States. In January 2025, the U.S. government signed executive orders that paved the way for a strategic Bitcoin reserve. Then, just a few months later, in July 2025, the Genius Act was passed to officially regulate stablecoins.
Let's look just a bit closer at that July 2025 legislation. The Genius Act represents the very first official U.S. cryptocurrency regulation. It was specifically designed to offer clarity and to help build public trust and investor confidence in digital assets. It establishes firm guardrails for stablecoin issuers. It mandates minimum liquid capital requirements, so these assets are, actually backed up by real money, and it creates strict anti-money laundering and anti-terrorism processes. The overarching goal of all these regulations is to safely and reliably integrate digital assets right into the mainstream U.S. financial infrastructure. So all of this brings us to one final, overarching thought. Is blockchain the ultimate replacement for trust, or is it just trust's next evolution? We've seen the flawless math behind cryptographic keys, the structural brilliance of Merkle trees, the incredible real-world applications across various industries, and of course, the growing pains of scalability right alongside new government regulation. So what do you think? Will this scalable, decentralized framework fully replace our traditional institutions, or will it simply force them to upgrade and adapt? As we look to the future of the digital economy, that really is the million-dollar question. Thanks so much for joining this explainer.